Fantastic. Let's start. So, good morning. My name is Pierre Schlosser. I'm an assistant professor at the European University Institute and the deputy director of the Florence School of Banking and Finance at the UI. It's really a great pleasure for me to welcome you to this joint online debate called TP or not TP, the macroprudential use of transition plans, which is organized together with CETEx, the Center for Economic Transition at the London School of Economics and Political Science. The reason why we have tabled this joint event is that we believe that transition plans do not yet get the exact level of attention they need, although they are said to be a central instrument for the decarbonization journey, also for prudential authorities, which are well represented in this event. And this is why we believe at the school and at CETEx that awareness initiatives and quality discussions are needed to ensure that everyone is on the same page as to what transition plans are and what they can do. So for this very specific and precise reason, I'm truly delighted to inform you that on the 12th to the 14th of May 2025, CETEx and FBF will be hosting the second edition of our transition planning course, a 3 days residential course held in Florence at the UI, and that will give you the essentials of transition planning. Now, let me turn to today's event. First, to reassure you that we'll take things step by step and will not delve immediately into the macroprudential potential of transition plans. We'll, in a first step, recall briefly what TPs are, where they came from, before slowly moving forward towards the prudential side. First, the microprudential side, and then the macroprudential side. Second, I'd like to recall that the discussion we are having today is very timely. The adoption of transition plans by European private banks is surging, with mandatory requirements taking effect throughout 2025, and both international and EU bodies are actively at work to iron out transition plan metrics and more details. So to discuss transition planning today, I'm honored to have with me 4 experts from the field. Let me present them to you by order of appearance. We have Agnieszka Smoleńska from the LSE CETEx. Welcome, Agnieszka. María, Nieto, and Agnieszka essentially organize the event together with me. So thank you also for that, Agnieszka. We have María Nieto from the Bank of Spain. Hello, María, welcome. Judson Berkey from UBS. Welcome, Judson. And we have the pleasure to have Paul Hiebert from the European Central Bank. Welcome, Paul. Before giving the floor to Agnieszka in a few seconds, let me briefly tell you how our discussion will be structured today. We will spend about an hour together. Our speakers will have about 5 minutes to provide the initial statement, and following this, I will immediately open the floor for a first round of questions from you. So you have a Q&A box on your screen that you can use to type any questions or indeed comments or indeed literature advice that you would like to, documentation you would like to share. And I'm going to revert to that in a second step. After this first Q&A, we'll reconvene with a brief discussion among the experts, and if time allows, and I hope that there will be time, we'll have a second round of Q&A. So with this in mind and with no further ado, Agnieszka, the floor is yours.
Wonderful. Thank you, Pierre, for this nice introduction, and indeed thrilled to be co-organizing this event. As Pierre mentioned, for the past several years, we've already been thinking about how to support central banks, financial supervisors, and the broader ecosystem around climate change and an environmental degradation thinking in financial regulation. So with these slides, which you will be able to find subsequently also online, and they will be shared with you, what I've done is to remind ourselves a little bit of the foundations of prudential transition plans. And as someone who has been working on EU regulation for over 15 years, I have to say it's quite a spectacular rise in a regulatory instrument. Perhaps only comparable to what we've seen straight after the great financial crisis. So what I wanted to start with is to managing a little bit expectations about what transition plans are and what they are not from a supervisory prudential perspective. We've seen a huge rise in net zero pledges from financial institutions. We've also seen some rollback behind these pledges. And I always like this title here that we see on a recent FT article, Can Banks Really Fix the Climate Crisis? And you can see like a sense of irony in this title as well, because this is not what we are trying to do in this case. This is not about whether banks are the answer and can fix. What we are trying to explore in the context of bank transition plans especially is how transition plans, understood as an aspect of an entity's overall strategy that lays out the entity's targets, actions, resources for its transition towards a lower carbon economy, how this strategic and risk management approach can support the core of what prudential regulation and supervision is there for, namely to ensure safety and soundness of individual banks and financial stability more broadly. It is therefore important, and this is the core of our discussion today, what is the prudential use case of transition plans that banks are developing? That is those aspects and elements of transition plans developed by banks that have a bearing on risk identification and management in a forward-looking way. We are therefore concerned with this prudential case more than the other use cases of transition plans that are also out there, namely those that are linked to either voluntary frameworks that are about reputation and communication. We are not focusing on the kind of conduct, corporate governance side of things. Our primary interest is the prudential use case of transition plans. This prudential use case has been developing and exists at several levels. So there is, after transition plans appeared as a regulatory instrument, there has been appeared in the financial sector more broadly. There has been this start of a thinking among central banks globally. How can this tool support us, especially in addressing some of the shortcomings of the macroprudential framework when it comes to really grappling with climate change and environmental degradation risks? So questions related to limited availability of data, a backward reliance on backward-looking methodologies, methodological limitations. And there is something about transition plans, the forward-looking strategy and risk management document, but also the action internally that supports prudential authorities in assessing banks' current exposures to transition risks, but also allows them to look at these transition risks in a forward-looking manner as they might develop over different time horizons. EU specifically has clarified this prudential use case of transition plans as part of a regulatory requirement introduced as part of the CRD6 that requires the development of specific plans that monitor and address financial risks arising from climate change and environmental degradation. This reform, and this is for you to have access later, is also anchored in a broader reflection of how macroprudential regulation and supervision should be adapted to properly address transition risk related topics. Now, what is important also in the context of our discussion today is that transition plans are a key element of the guidelines that the European Banking Authority published just a few weeks ago on ESG risk management on the basis of the CRD6 mandate. It defines transition plans as an overview and articulation of strategic actions and risk management tools deployed by institutions. So this EU approach to bank transition plans is indeed risk focused and anchored in the prudential supervisory framework. But what is also distinguished, and that's key from the perspective of discussing this in our discussion today, what we are interested in is not just what is disclosed, the communication side of things, but we are also interested from a prudential perspective in how integration of forward-looking transition risk assessments, how this changes the organization internally, how it changes the governance of risk related to climate change and environmental degradation in the bank. So we are interested in the transition planning dimension as well. What the EBA guidelines do, and something that will inevitably come up in our discussions later on as well, is to structure a little bit the expectations around what bank transition plans in the EU should be covering and what should be the principles governing the development of a prudential use case of transition plans. So the focus on verb rather than the noun, transition planning as an action, that also includes adaptation at strategic and risk management level. What is also important is the anchoring in existing prudential processes. So this is not about creating a parallel process, it's about integration of transition plans in existing risk and funding strategies, risk appetite definition, ICAP. Specific requirements are also introduced with regard to governance implications of transition plans and common foundations that will support convergence in approaches between the different bank institutions, supporting also, as we will see, a macroprudential perspective. For your information later, just to have a sense of how tangible the transition planning approaches already are. On this slide, we've drawn on a recent CETEx or a forthcoming CETEx publication that looks specifically at linking the transition plan components as they are developed on the basis of global and not necessarily sector-specific approaches to pieces of information, qualitative and quantitative, that can inform transition risk assessment within banks at the level of risk identification, but also risk management. And with this, I will close, passing on to María to explain to us the macroprudential perspective.
Thank you very much, Agnieszka. And indeed, I like the graph the chart that you use, which asks the question about the purposes of transition plans and how the distribution of answers was rich. And this was, I think, a year and a half ago. We'd be curious to see how, after the EBA guidelines, the picture changes to set common expectations. María, please, the floor is yours.
Okay, first of all, good morning, everyone, and thank you to the organizers for this invitation. Let me start with a disclaimer saying that whatever I say here represents only my views, not those of necessarily those of the Bank of Spain or the Eurosystem. I will pick up from Agnieszka and make an attempt to respond to the question whether prudential transition plans can help competent authorities to identify system-wide buildup of climate risk in the financial system. And let's start with a fact, is that climate models, integrated assessment models, do not include the financial sector. However, financial expectations play an important role in energy substitution. Could be an enabler or could be hampering this energy substitution. In the first case, the value of the financial assets will evolve according to a predictable manner, and we will end up with more renewable energy and less fossil fuels. Now, let me very briefly make, I think, an important distinction between the macro risk and the climate risk. And in my view, the sources of this risk are quite different. In the case of macro, you probably all know this very well, is the business cycle or is a structural. Is how big is the institution, how interconnected it is, or how difficult it is to substitute certain activities. Climate risks are very different. They build up over the long term with trade-offs between physical and transition risk, although we are already living into this. Non-linearities, the past is not a good predictor of the future, and high uncertainty. This is why climate risk scenarios go hand by hand with any analysis of climate risk. Because of this uncertainty, we need climate scenarios. This risk is exogenous to the system. So the best way not to have climate risk will be to avoid it or minimize it. But this is not always a solution. It's not always possible. And this is why transition plans come handy as a forward-looking climate risk management tool, because it will help us to understand, assess, and manage these risks. There are two elements in the context of the prudential transition plans as envisaged in Europe. I mean, the European Banking Authority has just released, ESG risk management regulation. And these two elements, one has to do with climate risk scenarios that should be checked against the targets of the institution. And the second one, the implementation strategy by the institutions themselves, how they adjust their financial terms, how pricing is adjusted, whether there is any herding behavior, the policies or the investment. But let me go back to the climate risk, to the scenarios. That I think that, as I said before, they go hand in hand with the nature of climate risk. Just let me define. Climate scenarios are different from stress test scenarios, both in nature and usage. What is a climate scenario? Probable representation of future evolution profiles of greenhouse gases, concentrations against various mitigation strategies, okay, which is government policy and technological progress. All of these subject, very important to a given carbon budget. They are in the regulation in Europe, there are different scenario brands that are referred to. And my point here is to say that one of them, the ones provided by the Network for Green of Financial System, are particularly well suited to the financial community because they are based also on climate models, as they are those that cater to the academic community. They provide transition pathways, they provide physical risk, but what is unique and necessary for us as macro-pru authorities is to have scenario contingent macroeconomic pathways, also downscale to sectors. Now, soon, we are going to have short-term scenarios that they are based on a suite of models. And there is now an innovation, is that we are going to have financial models included in this suite of models that account for the role of the financial sector in the climate mitigation pathways. And they will allow us to take into consideration the feedback loops between the financial sector, the climate transition, and the real economy. Let me conclude this very brief presentation with this artificial intelligence generated image. I'm very proud of them. To say that we need solid fundamentals to assess the macro prudential implications of climate risk. And we already have different tools on the table, disclosures, climate scenarios, transition plans, and climate stress tests. I argue that it's necessary to have regulation that is compatible in all these aspects. Moreover, that needs to provide the right incentives to financial institutions to report those misalignments and understand the implications for credit, market, and operational risk. I also think that we need competent authorities that are consistent, time consistent, consistent across regions, and also consistent, of course, across institutions. And with all of this, I think that we will be able to build market expectations that are consistent with the financial system as an enabler of a transition. Thank you.
Thank you very much, Maria. And I think the message on consistency came very clearly across, both in the analytical toolbox, but also in the integration of regulatory requirements. Judson, the floor is yours. You'll give us also the view from the market side.
Yeah, first let me thank you, Pierre and Agnieszka, for organizing this session. It's my honor to be with such esteemed panelists like Maria and Paul. Now this is supposed to be a debate, so I guess I'm probably a little bit supposed to be the source for the debate, given that coming from UBS and our Chief Sustainability Office, I sit close to our transition planning, so can offer a little bit of practitioner view, but also offer a few remarks from the perspective of serving as the industry chair for the Institute of International Finance's Sustainable Finance work. I think, look, you set the scene very, very well. So I guess I just want to reflect a little bit on how I think transition planning started within financial institutions. I think that is important to understand when it comes to thinking about their prudential use. It's a great time to be having this session. You referenced the EBA work that's come out, but there's also been 2 very good papers published already this year from the Financial Stability Board, one on transition planning, one on climate vulnerability analysis, which I think also are part of this overall discussion we're trying to have. Now, when I think back to where the financial sector started with transition planning back in, say, 2020, it really was an effort to outline by financial firms how they were going to support efforts to achieve the Paris Agreement that had been agreed by governments. Essentially, we were trying to make statements of strategy and how we would be working with our clients, counterparties, other sort of stakeholders, to try and support what governments had thought to do. And that's kind of how the transition plan concept was born. Now, it found its first expression and some guidelines, things like the TCFD guidance, which made in 2021 an update that included some very brief statements about having to have some kind of plan, explain what you're trying to do, how you're trying to manage some of the implications of climate change, climate impacts, climate risk for your business strategy. That led then into further development of guidelines by the market in the form of the GFANZ work, Glasgow Financial Alliance for Net Zero, and then some of the other coalitions that were developed. It has clearly grown over the years, as Agnieszka cited. If you look at the FSB paper, they actually showed the extreme growth in the number of firms producing transition plans starting 2021, 2022. It really started to explode. Clearly more on the way. Again, I think what firms were doing when they set these targets and started producing the transition plan, it really was a statement of aspirations. There was the Paris Agreement, an ultimate aspiration. And then we were trying to be guided by the science, clearly, but we were not offering guarantees. I don't think as financial institutions, we can't do that. As with any business strategy target, for example, a sales target or a cost reduction target, but these things are subject to factors well beyond our control, clearly, and even at times beyond the control of some of the companies whose emissions we're essentially inheriting when we actually make these statements of financed emissions or targets. Now, I think as Agnieszka rightly cited, the more important part almost is the planning. There is the plan, which is a document, a disclosure, an expression of what is intended and what it's hoped for and what's trying to be achieved. And then there's the planning activity. And certainly we can do a lot as financial institutions. We can offer loans with incentives like green mortgages or sustainability linked instruments. Investment firms clearly can undertake stewardship and engagement with portfolio companies. Insurers can support hazard reduction efforts of their insured counterparties. But at the end of the day, again, a lot of the decisions made that have the ultimate impact on emissions are beyond our absolute control, and they're influenced by the broader environment in which individuals and companies are acting, including obviously policies and regulations. And as we've seen, those things are subject to political trends and decisions. And so markets can shift quite clearly, quite quickly on institutions as they're trying to make decisions. Now, I think that I say all that because I think it just has some implications for what we can expect to do with the plans as they are today. I don't mean that the plans can't be further developed, and clearly some of the guidelines being put forward are intended to try and develop the planning and plan concept a bit and create some new information sets that can be useful. That's ultimately what I think some of the FSB work is really insightful on, particularly when it comes to thinking through what's the information set that would be useful for examining climate vulnerabilities system-wide. Because we have to differentiate. I think that's the point of this discussion, the micro from the macro. But look, I mean, one I think can intuitively think, okay, let's just add these up, and that'll give us the system view. And there's clearly a little bit of a logic to that, but obviously there will be gaps, right? Not every firm is producing plans. There are a lot of other actors involved, non-regulated institutions, state-owned enterprises, et cetera. So you're only going to get so much by adding together financial institution transition plans very directly. There's also obviously the thing I've commented on before is that, look, these are strategic plans. So while one can maybe have a level of certainty of action in what may play out on, say, a normal strategic planning horizon, 3 years, 5 years, when you're talking 10, 20, 30 years, clearly it becomes much, much fuzzier, and it's much more subject to a whole host of uncertainties and other influencing factors. And I think For the financial sector, again, at the outset, this was not necessarily intended as a risk management tool directly. Obviously, we have all of our core risk management processes, frameworks, and models and methodologies that we use to manage financial risk. Clearly, climate risk being a new driver that can change the dynamic of credit risk and market risk and other risks. But I don't think, at least from a financial institution perspective, we thought we were managing financial risk by creating transition plans. We thought we were making expressions of an ultimate business strategy to help support an over governmental objective or aspiration. And clearly there is a difference at times between the financed emission and the financial risk. I think the two most obvious examples in recent times would be the somewhat rude health of the traditional energy firms post the Russian invasion of Ukraine. Essentially, a lot of the traditional energy firms, the fossil fuel majors, are not at all for credit risks at the moment, and they are actually quite cash rich. So for the normal tenor of a loan, at least, the credit risk there is very small. Whereas on the other side, you can see companies that are absolutely doing what you would hope for to support the energy transition, at times not necessarily being the best investment or credit risk. And Northvolt obviously being the best example there. And so at the end of the day, the economics still have a large determinant on the financial risk aspect of companies, at least over the term of a business strategy decision. Now, obviously, if we're thinking longer terms at times, and there we have to think differently. And that's been the whole challenge on transition planning from the beginning. So when I step back from all this, I think the main point I would want to get across is, the financial sector, I think, approached the transition planning activity and the plan development from a certain perspective. Fully understand, supervisors wanting to make use of that information. It's absolutely what should be done. And I think this balance between the micro and the macro perhaps will require us to think about supplementation of some of the information, maybe viewing it in a certain perspective, and perhaps moving to a more rounded set of information ultimately that would be useful to hopefully support the supervisory perspective and interest in doing both micro macro analysis, and also the financial institutions use cases to support its own strategic efforts, to communicate well with its stakeholders, and obviously to inform some of the discussion with its supervisors. So I guess my answer to the question of the debate is yes, but we may need some further thinking here and some further development, and we should reflect a little bit on how the plans and the planning started and developed before we conclude that the information is of direct use into some of the activities that the supervisors would like to do. So with that, I will pause, Pierre, and back to you.
Thank you, Judson. This was very insightful, and I think when hearing you speak, I was thinking that actually you also described perfectly the move from the, let's say, first generation of transition planning, as you said, statement of aspirations, essentially piece of information, towards what we're looking at now, more a risk management instrument, more of a disclosure tool, and perhaps now going into the discussion where we're starting today, which is about perhaps the third generation as to how to use it also for macroprudential purposes, which is where Paul will be guiding us. So Paul, the floor is yours.
Thanks so much, Pierre. And hard to add to, I think, the already rich set of discussions. I'll do my best to complement. So just to note, my take on this is going to be, actually, it's a recent blog we'd written together with Agnieszka, my colleague Fabio Tamburini, our own personal views, not the institutional views per se, which are really about how a macroprudential approach to transition plans might not fully capture a macroprudential perspective, which might act as quite a powerful complement. And there's a couple of key differences I want to outline, which are related to macropru policy. And let me then launch into the next slide into the first. The first key difference, macro versus micro, ultimately is going to be about breadth of perspective. So it's the same content, after all. It's going to be transition plans across the economy, from banks to non-financial corporates and non-bank financial intermediations sector. But in the end, it's going to be about a different perspective on that. So if you look at this table here, what you see is effectively in the middle here, in bold, 4 different words. So one is about prepares, who presents. In this case, it's not just going to be banks if it's a microprudential, but also this broader ecosystem of non-bank financial intermediaries. and non-financial corporates in a macroprudential standpoint. The primary users, of course, would be also different when it comes to supervisory authorities, which is self-evident. And the mandate, of course, I think most of you are surely keenly aware of the idea about safety and soundness of individual institutions. If aggregated up, doesn't always equate to system-wide resilience of the financial system. And as for this assessment lenses, this last bolded word is effectively this idea that you need to think about a fallacy of composition, perhaps, whereby just adding up transition plans of individual institutions, notably in this case, banks is outlined here, might not give you the full picture, and it may not be additive, but rather interactive in terms of what's going on there. And this internal element of the financial system is important to think about. Maybe gaps, again, which are already outlined by some, in this issue that Maria noted about consistency. What is the consistency across the sector when you're thinking about these plans in their totality? The other element which may be important is not just within the financial sector interactions, but also this real financial interaction there. And that would be really about this element of potential misalignments. So banks are moving ahead of the real economy or vice versa would be something to flag, and a macroprudential authority could be thinking about this as we move along. Now, clearly, I think Judson had also noted this point about dynamic recalibrations, which is that the prevailing macroeconomic environment is shifting, and it's shifting often in ways we wouldn't have expected, notably when you're thinking about decades out, it can shift in marked ways. And that means, of course, we have to think about this idea of updating as we go along. And I'll come back to that point because I think it's an important one. So just in this slide to note, there's this element of breadth of perspective, and we need to think about within financial sector interactions. So this fallacy of composition to get around this idea that it's all additive, and maybe there are top-down perspective through all the stress testing that's being done can help also act as a check in terms of consistency, but also misalignments with respect to the real economy. Next slide just gets to this idea away from narrowly thinking about breadth of perspective alone. Macropru can also differentiate across different phases of the cycle. And here we tend to think about financial cycles in macroprudential policy. Now, those tend not to be short. If you look at the financial cycles literature, it can last up to a good decade, a financial cycle. So it can be that these phases last quite some time. And what you see in these bubbles here is that we would maybe want to differentiate across a build-up phase from a materialization phase. In a build-up phase, one would think about this potential for speed limits. So I'd already spoken to this idea in particular about the financial sector and the real economy. There's this interplay, of course, lender and borrower in a collective sense. And what one would want to balance in a way, which you could think about maybe as almost a quadratic function, that you want to be at this optimum with not too much, not too little, in terms of the speed of adjustment. So insufficient adjustment, obviously, if you look across the stress testing that's been done in the official sector to date, also some in the private sector, it tends to show that effectively early action can help. Prevention is better than the cure. You want to think about this slow-moving element of the climate, either chronic or acute risks rising through time, require upfront adjustment. But of course, unduly stringent adjustment at the same time can be an issue insofar as you might have done too much transition intensity. So this idea about a minimum and a maximum speed limit to collection, the collective lending of the sector. And here again, a macroprudential authority can be quite helpful in trying to see when maybe there's, on the one hand, the financial sector is going too slowly into transition, but also maybe is going too quickly, and in a sense, maybe risking transition finance if that misalignment of the real and the financial sector is there. So in this respect, a macroprudential approach can be, again, a check, just to see if what's happening at the level of individual institution and aggregated up may be the same as what you might see from a top-down perspective. Now, in the materialization phase, you'd think about this element, traditional ones like contagion, spillovers, and that can be elements of across institutional sectors. So Judson had talked about the intersection of governments and financial institutions. Of course, there's a real economy sandwiched in there too. And you think about this interplay there, could mean you have contagion or risk transfer across different sectors. How might that look? What could be some potential scenarios that are drawn up by a macropru related authority on this topic? And how could that compare also to what we're seeing in terms of disclosures? The other element, of course, is spillovers across countries, across sectors, and this element of interconnections or commonalities of exposure. So all this in mind, what I want to get at, and a couple of points again, just to reiterate, is this idea that we have this breadth of perspective and differentiating across a cycle. What can it help us with? Well, in a sense, it's an ability to be more holistic as we approach these questions, and mismatches notably between the financial sector and the economy or within the financial sector, but also that we could update along the way and have this dynamic recalibrations. So this aspect of macro financial conditions feeding into our discussion in an updated way. But also when we have uncertainty which are decades out, it's sometimes good to have a hedge against model risk. We might not have any of us the individual right model to predict out 2, 5, even 10, 20, 30 years. But collectively, I think we can compare across model results and that can help. And sometimes those models can be also top down at the macro level. So with that in mind, these are some general considerations, but keen to pass back to you, Pierre, so we can kick off a discussion and a debate.
Thank you very much, Paul, and also for framing this analytically in the best possible ways. I wanted to give a chance now to our participants to come up in the debate, come in. There is a Q&A box that is just below on your right, where you can add your questions. There is a question that is actually more of a statement, but we can still take it as a starting point for reflection. From Ioannis Sturpis, who is saying that the ECB declared that 18 banks did not comply with the requirements within the deadline, and thus, I'm reading word by word, and thus ECB intended to impose daily administrative fines, which is a very intrusive measure. However, so far, we haven't seen the publication of the administrative penalty. So personally, I haven't followed this, so I'm not sure whether this is strictly speaking relating also to transition plans. Agnieszka, would you like to generically comment on this, and then we can have a discussion?
Yeah, absolutely. I'll do it very quickly, and I'll also link it because the starting point for the fines that are being referenced is of course the 2020 guide on climate and environmental risk management that the ECB has published soon after the reference to ESG risks entered the EU macroprudential rulebook for the first time in 2019. And it links very much to transition plans. And I think it speaks also to how the flurry of activity in the alignment versus risk management space leads to, there being also different narratives around what happened. So when you read the guide from to 2020 from the perspective of transition plans and transition plans as a source of additional information to support risk identification and management, you really find quite a few references there already to forward-looking statements, to thinking through sectoral lens about risk exposure over different time horizons. So this is, you can very much, if you kind of read it through the way that the transition planning debate has evolved, very much in 2020, you already see in ECB's approach some tenets of a prudential approach to using transition plans. Of course, we expect now the guide to be revised. But in the context of the fines, what happened after 2020, I think is a very interesting kind of very sequential step-by-step process of ECB asking banks how they are progressing as far as the implementation of the expectations anchored in mandatory requirements under the EU prudential framework are progressing. There was a very, I would say, quite an open publication of thematic reviews, subsequent peer reviews, where the ECB very clearly communicated which types of climate change and environmental risk management approaches were sufficiently adequate or not. So indeed, we are now at a moment where time has come not just for the carrot but the stick after 5 years or so to also after this very progressive, almost collaborative, you could say, approach to developing methodologies, that time has come to use supervisory powers. Of course, administrative, you can think that this is a very intrusive measure. I would think that there are also under Pillar 2 even more intrusive ones, including additional Pillar 2 requirements, or indeed or indeed use of supervisory powers that reach more inside the organization, requiring specific changes to management, operations, etc. Powers that are even expanded under the CRD6. So on the scale of interventions, you could say that administrative penalties are quite a small stick, given the process and the toolbox of ECB to intervene here.
Thanks a lot, Agnieszka, for resituating this discussion and this question. So we have three more interventions. The first one is by Pierre Monin. Bonjour, Pierre. So it's the following: isn't the implementation of transition plans in the self-interest of the banking sector, not just the supervisory requirement? Putting it in other terms, will the banking sector strive more in a 4-degree world or in a world with economies that have transitioned? I would assume that this is a question that goes to Judson, but then we can have a broader round, and then there will be two more questions coming in a few minutes. Judson, over to you.
Yeah, like I think my response will be the same as the response to your question, Pierre, which is yes, but, and the but here being, we cannot ignore essentially what role the financial sector can play and what it cannot play in terms of, we cannot direct our clients to undertake new investments if they're not economic for them. We cannot control government policies incentivizing or disincentivizing certain activities. This was something we wrote about as the Institute of International Finance last year in a paper. And yes, absolutely, there's a lot of things that banks can do and be supportive on, but at the end of the day, the economics still need to work for individuals and companies to make investments in decarbonization. And if they don't, there's only so much that can be done as part of a financial institution transition plan.
Thank you, Judson. Anyone else on this question?
I could
Paul?
jump in. Yeah,
Yeah.
just to note, I think it was a nice speech of our chair, Claudia Buch, last year, and the supervisory side. She noted the average maturity of a bank loan is around 9 years, and the average maturity of a bank's liability is less than 3 years. But you could say the bank balance sheets are a bit like a chain that links the past to the future. So assets reflect economic structures of the past, are affected by climate-related risks, but also you have this new lending, and it provides opportunities to support investments into the future. And in this respect, you can think about the alternative of a transition plan if you don't have it in terms of information is often current emissions. And that is certainly an imperfect measure of exposure to climate risk. So I think it is in the individual institution's interest to also think about business model planning. And that's been fundamentally part of how the ECB has also been framing its discussion with the financial sectors. To think about this business model planning aspect is in the natural interest of the financial sector as much as it is the supervisory side in terms of risk.
Yep. María?
If I may ask, I mean, I think this also goes with your comment before, Judson, exactly that, I mean, how you see this, I mean, that you perceive being out of the control of the company at certain point, you said that. I mean, I wonder whether here we have a disconnect between financial policies and government policies, because they are. I mean, these commitments are at national level and they are national determined contributions. I mean, these countries sign the Paris Agreement and they committed to produce these national determined contributions and, inform every year, every 2 years of what are the developments. And then there are measures that, include emission reductions, or others include, the use of technologies to eliminate emissions. So I wonder whether this is not already a practice that some sort of matching, some sort of matching of what is required at national level in terms of the energy mix that is required to meet this objective, and what would be, the energy mix used by, your corporates. I mean, it's well understood that some need to go through this transition, but, some technologies are available, others are not available. I mean, I don't think that financial institutions are acting in a vacuum, not at all. I wonder whether I misunderstood a little bit what you said, which I think is related to this point. Thank you.
Judson, would you like to come back in? briefly?
Yeah, sure. Happy to respond. Yeah, just make sure that there's no misunderstanding there. Yeah, I absolutely agree with your point, Maria. Yeah, we need to look at this as a whole economy activity and a whole economy transition. And governments, need to provide the conducive policy frameworks to support that. We obviously need to, understand what current policies and future policies may mean for the economic viability of certain activities and then their ultimate creditworthiness and investability. So yeah, the more that can be clear for everyone, the better everyone is. I think the reality is government policies are not guiding economies nationally nor globally to the Paris Agreement objectives, if we're brutally honest. If you look at all the assessments that are made by the international groups, you look at groups like Climate Action Tracker only rating a handful of countries as even barely adequate on the Paris Agreement. So until those policies get in place, then companies are really not going to have the investment certainty that they need to make what they view as good economic investment. So the more that we get clear, not just scenarios, but real policies that put forward the clear markers of how certain sectors are going to evolve, whether it's phase out of EVs, whether it's renovation of buildings, whether it's scale up of renewables, then as that gets clearer for companies, that's great. And as certainly we want to be part of that whole discussion and mix. We recently wrote a paper as UBS to take a look at the Swiss transition plan, so to speak, and the Swiss government, to their credit, I think has done a tremendous job outlining a set of scenarios and guideposts for how they see the scale up of renewals, renovation of buildings, the carbon removal needed to offset ultimate emissions that may not be mitigated fully by 2050, and put forward clear guide outline of what that plan is for the Swiss economy. I think the more that countries can do that sort of thing, it's really very, very, very helpful for financial institutions to take action and for obviously our clients to take action.
Thank you for this, and indeed that could be another potential use of transition plans, which is essentially a coordination device for some policies implementation. I wanted to stay on Paris because there is a question that was related to Paris, which is the following by an anonymous attendee saying, Judson mentioned the role of political developments and that transition plans for banks started as a strategic tool. Observing that many banks, in particular from the US, are now leaving the GFANs and similar initiatives, would say that this reflects a strategic reorientation of banks, potentially departing from pursuing Paris goals, or is it mainly about adjusting communication strategies? So again, do you see a big shift in the political positioning of banks on climate issues? Or is it just adjusting communication strategies? And I will not ask you, Judson, now. I think I'll just leave the floor open as to whether Agnieszka, Paul, or María want to answer this question. I think all eyes are on the US these days. It's not a big surprise, and it's very logical. So I don't know if anyone is inspired by developments. I would like to see some comments in that space.
I mean, I can say a few words maybe from the European perspective as the independent academic on the panel. So I would say that of course this matters for reputational reasons, and there is a sense in a number of jurisdictions, or is it a sign of a rollback? But I think what the FSB recent publications show is also that just because we don't have a voluntary initiative in place, the risks related with climate change and environmental degradation won't disappear, right? It's not the existence of these risks and their material impact of financial stability in the context of individual institutions or systemically, it's not affected by whether voluntary initiatives exist or not. GFANs did a fantastic work in setting up the basic framework for what transition plans are. And in a number of jurisdictions, as we also see in the Financial Stability Board document, which looks at the financial stability uses of transition plans, we see a very long list of jurisdictions that in one way or another have introduced a transition plan or transition planning requirements. In the EU specific case. It's also worth to point out that the guidelines that will be applicable to large banks from next January and to smaller and non-complex banks from 2027 are very much use the GFANZ approach also. So, but they are transforming this voluntary initiative that was driven largely by the private sector into a mandatory set of rules that will also determine how supervisors will be looking at bank transition plans. So we see also this transformation of a voluntary framework in the EU context into something that is mandatory and applies to international and third country operations of banks as well, and to non-EU banks that are active in the EU market.
Thank you, Agnieszka. So questions are coming on stream, and that's really nice. So feel free to continue. Some of them are more practical oriented now, and some relate more than to the macro side, to the macroprudential side. So let me start with a question by Cosmin Creanga, who is asking, how are banks / non-financial companies, so how should they navigate the policy uncertainty related with the proposals to delay certain pieces of legislation or intermediate targets? How should transition plans be prepared at this point, only having in focus only the 2035 or 2050 targets? I guess this is a reference to what's happening with the CSRD and the other piece, or what always the acronym. So this is clearly something that has been in the focus in the political debate recently. So who would like to go for that question? Agnieszka, would you like to start? And
I mean, I can just copy the guidelines in the answer, and I think that would be very useful because the guidelines also do a fantastic job in bringing some convergence to the space. So you can very clearly see that what the EBA is trying to do is to reduce regulatory burden by showing clearly how different regulatory requirements overlap. And this seems to me the more efficient way of going forward in terms of reducing regulatory burden, clarifying, simplifying, showing consistency rather than reopening mandatory requirements over and over again. But I think all these answers, including how they should be prepared, details in the EU context, that's covered in the guidelines. And there are also some very interesting macroprudential questions. So maybe we could also
we will go
bring
there
these
now.
up.
Yeah. But before that, I'm keen to address all questions. So there is another question that has more to do with the capital requirements. So anonymous attendee is asking, what are your thoughts on the inclusion of capital requirement increases for banks not fulfilling their transition paths or embedding minimum green lending or maximum dirty lending quotas? Let's go back to Judson, and then if Maria and Paul, you'd like to come in, feel free.
Yeah, I think generally we have a prudential framework that has been built around notions of risk and financial risk in first instance and over defined time horizons. So if that's the framework we want to keep, and that's an if, there's an if there, I said, then I'm not sure that immediately, green, brown, so to speak, adjustments fit so well into that, unless you really have the evidence of the risk differentials. Maybe in certain cases it's starting to develop. You see some data, series coming out on, say, buildings, green buildings, and having lower, default probabilities, higher resale values, lower loss rates in general. So maybe that the evidentiary case is starting to build there. Obviously, one can conceive of different kinds of prudential frameworks, and I think that's a little bit what this debate was about. And I think Paul, you usefully highlighted, essentially, the macro pru concern and whether there may be at times when you see risk building up, need for macro pru measures, but those are different than capital measures. And so I can conceive of scenarios and cases where, clear from a macro pru point of view. Look, if you see withdrawal of insurance from key regions that are going to be increasingly exposed to fiscal risk events, and we've seen some of these in the US in particular, that's something clearly of concern, right? Because there's embedded assumptions there around insurability. And if those are no longer valid over time that you can foresee, then clearly that's the sort of risk that we need to be attuned to. So I think that absolutely, there are macro-pru ways to be thinking about this topic, and to the extent that one can envision, buildup of risks on a system level, it is not, unreasonable to think about macro-pru kind of measures that could be used to try and address that.
Thank you, Judson. So we have 5 minutes left, and I'd like to dedicate them to macro-pru and bring in both Paul and Maria. So the first question is by Daniela, and then there is a question by an anonymous attendee, and then the last question, I will not actually pick it up because it has to do also with the current political events and the transition direction, etc. And I think we covered that to some extent already. So the question by Daniela is the following: how would you suggest to make use of transition plans for macroprudential objectives more practically? So she's saying, as the transition plans are individual for each bank, do you have ideas how to merge this information to feed as additional information into the assessment of systemic risk for the whole financial sector, especially if the banking sector is large? Question mark. Maria, would you like to start?
Okay. Well, I think that when one looks at this, I mean, to the extent that that transition plan is based on a scenario analysis, I think the best is to clarify to everybody that those climate risk scenarios are top-down exercises. I mean, the climate risk are or the alignments, the energy mix, the investments that are necessary, the emissions, the price of emissions. All of this is a top-down exercise. So what banks are going to have in practice is going to be the country assessment or the country downscale of a global model. So by itself, this concept of addition, in my view, is odd when we talk about climate, because everything is added, at the global level and then downscale at the national level. Okay. So this is something we have to bear in mind. It's not like a stress test where you put together balance sheets or income statements. It's a completely different exercise. So what you are going to do is basically, as I just mentioned before to Judson, is to say, well, listen, where are you as a country? What is your national determined contribution? Where would you be if you are not, for example, in line with more ambitious objectives? And what is, for example, the policy mix of your large companies? Okay, so in my view, and I think Paul has explained this very nicely, this doesn't lend itself to adding up. This more lends itself to understand the nature of the deviation and understand what is the meaning of this deviation. I mean, for example, I'm going to put you an example that I have very fresh in my mind because it's a Valencia case. You have a cement company in one place, and then you have another cement company in another place. The first one has climate risk because it's not investing in carbon capture and storage. The other one, okay, has invested in carbon capture and storage, but is situated by a river. Okay, so it's subject to floods. Both of them are subject to climate risk, but you need to understand what is the origin of each of them. One, maybe it's a matter of, as Judson says, a matter of insurance, or simply it's a matter of needing to redeploy, the assets of the company. The other one is simply that it's not, internalizing the fact that needs technologies that reduce emissions, just, almost by definition. So in my view, transition plans and assessment of scenario analysis should be not seen with the same eyes as you see an exercise of stress testing, because it has elements that are top-down by definition, and there are elements of deviation that you need to explain one by one, not only bank by bank, but also, credit by credit. And the overall picture will be probably more relevant sector-wise, activity-wise, and, understand what are the geographic dependencies of that country. That, in my view, it will be, I mean, if I would have to start this from the scratch, this is how I would do it.
Absolutely. Very interesting also what you're saying about sector-wise. I think that there's a lot of potential in getting deeper on that side of the comparative analysis of transition plans. Now, we only have actually time is up, but we will invest 3 more minutes into the event. So Paul, you have 1 or 2 minutes so that I can have 1 minute to conclude right after. Do you agree with María?
Yeah, so I think the issue is, we're in a world of imperfect information with a lot going on. And indeed, there's shocks occurring daily, and there's some very recent ones which are quite meaningful shocks in this environment. So in this environment, you want us to ask what's the best approach to have a robust policy, which is effectively building up the information base which is needed for good policy and needed for good financial institution level risk management. And so I think in this respect, you can think of a couple of things. So one is the aspect of benchmarking that we're seeing our macroprudential supervisors doing. There is action. Judson's talked about some of this. So some best-in-class banks are doing things very well. GFANS was another one Agnieszka mentioned, which can also give us examples. We can sandbox a bit, build on this, find ways to also have best-in-class reporting, replicate and look across the sector how to do that better. With that in mind, of course, we get to a standardized set of information, which can be quite helpful. And that's where the aggregation can take place. And that aggregation need not necessarily be in a steady state, all banks. You could think about even in a transition now as we're looking at a few banks which are best in class, picking up some of the key banks. What are they doing? How are they doing it well? And comparing it to the top-down elements we're seeing that María is mentioning, and seeing where there are gaps, where there are inconsistencies, where might we see underinsurance, as Judson mentioned, where might we see some questions in the system where we might want to firm that up just to ensure that neither policy nor institution level planning faces impediments. And here I think it's in everyone's interest to plan, and it's in the collective interest to have an information set which allows us to do that in a way which is also well informed from between others. So with this in mind, I pass back to you, Pierre.
Thank you very much, and thank you everyone for your contributions. I would be curious actually to make a poll, but we cannot do that last minute, to see whether participants were convinced that there is a potential use for macroprudential purposes of transition plans. My takeaway is that there is a lot happening in the space. It is that transition plans are still very much a moving target, that they have evolved over time, that still many do not use it systematically for all the purposes that they could be used within companies, but also for prudential purposes. So I would be curious to perhaps meet again in a year and try and see how the space has evolved, and how also the awareness of using common metrics based on the new guidelines, using common methodologies, also perhaps testing some of the transition plans also in given sectors where we have very clear scenarios would be helpful to get new findings as to how much of a tool can it really help, because I think there are things we can expect from transition plans. We cannot expect transition plans to do everything for us. That's also one of my takeaways. Mm-hmm. Thanks a lot again to everyone. Thanks a lot to María, Judson, Agnieszka, and Paul. Special thanks to Agnieszka for teaming up with the CETEx and FBF to make sure that this event could happen. And really happy that we had about more than 70 participants. So I'd like to thank, last but certainly not least, all participants, as well as my colleagues from the online team at the school, Jan and Claudia, for making this event happen. Have a great day, a great rest of the day, and hopefully see you very soon. Perhaps also in Florence in May if you'd like to continue the conversation on transition plans. Bye.
Thank you.
Thank you.
Thank you.
Thank you.
Bye. Bye, everybody. Bye. Thank you.